Hi everyone and welcome to a brand new episode. I'm Marcus and today we are looking at Johnson & Johnson, ticker symbol JNJ. We will cover the income statement, balance sheet, cash flow, key figures, our key feature and a technical aspect of the stock. Should we be buying the stock? Let's find out. So Johnson & Johnson have more than 140,000 employees worldwide engaged in research and development, manufacturing and sales of a broad range of products in the healthcare field. The company's primary focus is products to human health and well-being. They are organized into three business segments: customer health, pharmaceutical and medical devices. The company sells the products in US, Europe, Western Hemisphere, Asia Pacific and Africa, and 50% of their revenue comes from the US. And with that said, let's look at the numbers. They are traded on New York Stock Exchange and are in a life science sector. If you go down to the screen, we can see that their market capitalization coming in at $467 billion and their revenues at $93.8 billion. PE ratio coming in at 22. Now guys, I like companies with a PE ratio of 20 or below, so coming in at 22. I understand it's not far from the threshold, but it's still higher than what I normally like to take a look at, so that is a no for me. But guys, when you see a stock with a high PE ratio, that tells you that the market expectation of that stock is high, and therefore there are a good chance that you might see capital gains on those stocks, because there's a lot of investors pushing the price even higher because they're expecting higher and higher, better and better numbers. But the overhanging risk, as we have seen with Netflix, PayPal, Facebook, is that if the company doesn't meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with low PE ratio. That tells you that the market expectation of that stock is low, and therefore you might not get good capital gains on those stocks because the market is not expecting much from those stocks. Just keep that in mind. But having a PE ratio of 22, that is too high for me. Now, profit margin coming in at 22%. I like it because I like to take a look at companies with a profit margin of 15% or higher. So coming in at 22, that is just acceptable. That is good to go. So I like it. So that is a go. Price to sales ratio coming in at 4.9. Now I like companies with a price to sales ratio of maximum 4. So 4.9. I understand, same thing here. It's not far from the threshold. I understand you want to be flexible, but still in my case, this is higher than what I normally like to take a look at. So that is a no for me. Price to book value coming in at 6. Normally I like companies with a price to book value of maximum 3. So coming in at 6, that is too high for me. So that is a no. So if we were to summarize, PE ratio is too high, price to sales ratio is too high, and their price to book value is too high. This tells me that Johnson at its current state is overvalued. So they pay out a dividend of $4.19. I like it because I like those recurrent income, so that is a plus. Effective return at 2.4%, a bit low. I would like to see at least a 2.53%. It would be acceptable, but I would like something around 6%. But at the same time, guys, as I have mentioned, don't just jump the gun because you see a stock with a high return, because that could be a trap, meaning that I would like to see that you look at this chart, look at the history of the company and see, okay, is this stock consolidating or is it moving in a negative trend channel or positive trend channel? Because the risk is you buy because of the high returns, you get good returns of those stock as long as you hold those capital. But when it comes time for you to exit the stock, you might not get a higher price than what you bought it for. So just be very cautious here. So coming in at 2.4, that is a bit low for me. So that is a no. Return on equity coming in at 30%. I like it because what it's telling me, return on equity tells you about a company's ability to create return on their equity. And as for an investor, you want to make sure you have a company with a positive return on equity, because that tells you that they are able to create return on the capital you're about to invest in them. So seeing a level of 30%, I like it. So that is a goal for me. Return on assets coming in at 8.8%, a bit low, but still acceptable number. I like that. So the stock is currently traded at $177 per share. If we go down to the moving average, we can see that we are above the 50-day moving average, but also above the 200-day moving average. So the indicator is telling us that we might see the stock price increase. So, but if we take a quick glance on the chart, we can see that we have been moving within a positive trend channel for quite some time, but have since late September, early September, seen the stock price move even lower. But if we glance back a bit, we can zoom out a bit, we can see that we have been more or less consolidating the whole time and has of lately seen higher levels. But we'll take a closer look at the technical aspect of the stock further down. But let's jump over to the income statement, and what we can see here on the income statement is that the total revenue went from $75.3 billion up to $93.4 billion, and these numbers have been improving every year. That is a plus. We can also see a huge jump between 2020 and 2021. Gross profit went from $51 billion up to $63.9 billion, and these numbers have been improving. We fell off a bit in 2020, but overall trend is positive. Net income went from $1.3 billion up to $20.9 billion, and these numbers have been improving. We fell off a bit here in 2019, 2020, but overall trend is positive. I like it. Now let's jump over to the balance sheet. What we're interested in here is that the current assets versus the current liabilities, and we can see that there is a huge difference between the current assets and the current liabilities. Basically, what it's telling you is that if the company were to convert all their current assets to cash, they're able to pay off their current liabilities and still have capital left on the table. So that is a plus. I like it. But now they are far from being able to pay off their total liabilities, which is a shame. That is negative. And if we take a look at the total liabilities, we can see that it went from $97 billion up to $108 billion, and these numbers have been growing every year, and they paid off in 2021, which is a plus, but overall trend is negative. I like the fact that they reduced their total liabilities, because I would like to see companies reducing the total liabilities, also reducing the rate which liabilities are growing. So seeing that these numbers are growing, that is negative. Now, outstanding share, we can see it went from 2.7 billion shares down to 2.6, and these numbers have been decreasing over the past 5 years. That is a plus. So guys, what is happening here is that when you see that these numbers are decreasing, that means that the company is doing buybacks. That means that there are fewer and fewer available shares out there, making your share of the company grow. If we were to see this number increase, that means that the company is issuing more and more shares, meaning that there are more and more available shares out there, making your share of the company decrease. That means that you are being diluted as investor. And I have mentioned this, a lot of investors either skip this part or doesn't know about it, because they've been looking at a company's balance sheet, and for instance, they see a company with a strong balance sheet. For instance, they have a lot of assets, their debt's not growing that much, which is positive, which is great. This is what everybody wants. But on the other hand, we can see that the company is issuing more and more shares, and that is negative. But at the same time, that is a way for a company to bring in more capital without taking on more debt. So be very cautious here and make sure that you look at the outstanding shares, and seeing that these numbers are decreasing, that is a plus. I like it. Now let's jump over to the cash flow, and what we can see here and are interested in is that the operating cash flow versus the capital expenditure, and we can see here that the operating cash flow came in at $23.4 billion and the capital expenditure at $3.7 billion, a huge difference here of $19 billion. So that is a plus. And we can see that operating cash flow went from $21.1 billion up to $23.4, and these numbers have been growing every year. That is a plus. The capital expenditure went from $3.3 billion up to $3.7, and these numbers have been growing. We fell off a bit in 2019 and 2020, but overall trend is positive. I like it. I like it that the fact that they are continuing to invest in their business. So that is a plus. Now let's jump over to the key figures, and what we can see here is that the earnings per share went from 48 cents up to $7.93, and these numbers have been improving every year. That is a plus. Revenue per share went from $28 per share up to $35.4 per share, and these numbers have been improving every year. That is a plus. Equity per share went from $22.4 per share up to $28 per share, and these numbers have been growing every year. That is a plus. Dividend per share went from $3.3 per share up to $4.1 per share, and this number has also been growing every year. That is a plus. I like it. I like it because I like those recurrent income, and also that the income is growing every year, so that is a plus. Dividend share went from 687, a bit of fluctuation here, 62, 65, 73, 58. Lately they have been below 60% because I like companies that pays out less than 60% of their capital, because I want some of the capital to remain in the business for investment, acquisition, and just overall strengthening the business for uncertainty. And seeing that lately below 60%, I like it. But the gross margin went from 67% up to 68.4%, and these numbers have been improving. We fell off a bit in 2019 and 2020, but overall trend is positive. They regained it in 2021. Operating margin went from 23.4% up to 24%, and this number we fell off a bit in 2018, 2019, 2020, and lately improved. But overall trend is negative, but I like the fact that they improved lately, so that is a plus. Profit margin went from 1.7% up to 22.3%, and these numbers improved. We fell off a bit in 2019 and 2020, but regained again in 2021. That is a plus. Return on equity went from 2% up to 28%, and these numbers have been improving. We fell off a bit, but have since regained again in 2021. That is a plus. Return on assets went from 0.8% up to 11.4%, and these numbers have been improving. Same trend, and we fell off again, but regained in 2021. That is a plus. Solidity tells you about a company's financial strength for the long term, and we can see here it went from 38% up to 40.6%, and these numbers have been improving. Same trend here. We fell off in two years, but have regained, so that is a plus. Balance sheet liquidity, same thing as our solidity, but here it looks at the company's financial strength for the short term, and we can see it went from 0.65 up to 0.97, and these numbers have been improving. We fell off a bit in 2019, but have since seen better and better numbers, so that is a plus. Debt ratio went from 1.6 down to 1.4, and we can see that these numbers have been falling. They increased this number a couple of years, but have since in 2021 reduced it, so that is a plus. Basically, having a debt ratio of 1.4 is telling you that the company had 1.4 times more debt than equity, and seeing that this number is improving, getting lower, so that is a plus. Now guys, we have gone through the income statement, balance sheet, cash flow, key figures, and now over to our key features, which is the stock analyzer. What the stock analyzer does is that it gives you a simplified, holistic overview of the company's performance, and it saves you a lot of time. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. If we go down to the screen, we can see that the PE ratio is above 20, which is negative. The company do pay out the dividend, which is positive, and the dividend payout share was less than 60%, that is positive. And dividends have increased over the past 5 years, that is positive. And the number of outstanding shares have decreased, that is positive. Revenue increased over the past 5 years, that is positive. Profit margin above 15%, positive. Profit increased over the past 5 years, positive. Current assets greater than current liabilities, positive. Solidity increased, positive, and balance sheet liquidity increased, positive, and debt equity ratio decreased over the past 5 years, positive, and the total liabilities have grown over the past 5 years, negative. Guys, as you can tell, it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers or have the software do the heavy lifting for you. And you can have the software along with everything we've gone through, plus access to our discussion forum where you'll be able to chat with me along with other members for only $10 per month. So make sure to head over to comus.se and become a member today. Okay, thank you. But now let's jump over to the technical aspect of the stock. So guys, here we have the chart. As you can see that we have been moving within a positive trend channel for quite some time, for many years, and the trend have not changed. But what going forward, what I'm interested here is that I believe this is a strong company, stable company with a lot of things going on. The financials is looking really good, so I don't see anything in foreseeable future that could change the direction here. So but we also need to be looking at a safety or margin before we enter the trade. So sure, one way you could do is that you could be doing dollar averaging, meaning that you could be buying here even though the stock price be falling and going down. You could still be buying because you're doing the dollar cost average. That's a way to do it. So but what I'm looking at is for me, I'm okay of waiting. So I think what because the trend is the same, so I predict that what we will see is that the stock is now reaching the resistance level here, as we've seen over and over again. It might break above this area, but I believe what we will continue to see this formation, meaning that we will hit the resistance level here. The stock will fall back down within the channel, and then for the buyers to come in and enter here and just push the price back up again. So that's how we'll trade the stock. The reason why I like this stock so much is that sure, it's a boring stock. It's not a lot of thing going on, but what it gives you, it gives you opportunity to buy more and more shares and just earn those dividends, and just make sure to get in the right levels, which you consider is right level for you, and just earn those dividends, and perhaps even though be earning some capital gains. And this is what I have talked about, not just jumping the gun on when you see a stock with high returns, because as we can see here, this is the direction we're going on. So as a plan, I plan to execute would be to be either do dollar cost averaging, or just wait for the stock to go back down and just be buying more and more and more and more, and just have those stocks pay you a dividend and earn those capital gains, and then reallocate that capital to a different stock, or whether how you want to weight your portfolio. So that's what I would do. So if we are to summarize my thoughts of the company, this is a large and stable company, and the stock is for the moment overvalued, but I believe we could see the stock price move towards the support line, making it more attractive to purchase for better returns. The year-over-year performance is just impressive, and the financial is looking really good too. But one thing I think we need to consider is the development between 2020 and 2021. We need to ask ourselves, is this jump sustainable? I'm thinking, for instance, the revenue jump from 82 billions to 93 billions. Even though the company gets a green check mark on most of the boxes, I don't like the high dividend payout share. I'd rather have a more conservative payout share in order to have more flexibility. For example, reducing the liabilities, making investments, acquisitions, and just strengthening the business for uncertainties. But overall, I really do like the company, and if I would score the company, I would give them a score of 72%. So that's how we would trade the stock. How would you trade the stock? Please let me know in the comment sections below, and also let me know if you have any questions or have stocks you want me to take a look at. And as always, please do your own analysis. Thank you so much for watching. I am truly grateful and I appreciate it. And if you have enjoyed this episode, please give me a thumbs up, comment, subscribe, and until next time, guys, take care. Bye-bye.